The market is wild, and you already know that, but the question is, what are you doing in this market to stay the course and to set yourself up for success? Bulls and Bears is Steven here. Today, I want to share a few strategies and a few reminders on things that we should do, but things that we rarely think about, especially in times of volatile market. So think of this as a mental exercise. Yeah? So let's check it out. Number one, have a strategy and remember to follow through with your strategy. Before starting to invest at all, or at least investing big, please have a strategy. Maybe that's figuring out what kind of investor you are. What is your time horizon? Are you a long-term investor, 5-year, 10-year, 20-year kind of mindset, or a swing trader, for instance? We're talking about days, weeks, months, or even a day trader. When will you buy in and when will you sell out of a position, for instance? But having a strategy is only half the battle. Please follow through with your strategy after you have that strategy. When the market takes a nosedive and your account is in the deep red territory, do you actually remember to execute your strategy, or is it down the drain?
Never go down the hole. Never go down the hole.
I mean, if you have the most profitable strategy ever, but you don't stick to it, I mean, what's the point, right? And what this means is, if your strategy is to dollar cost average into, say, QQQ on the first day of every month, and I'm not saying this is my strategy or you should do the strategy, but as an example, then you should follow through with that strategy even if it's trending up or down or sideways. That shouldn't matter to you. Don't just switch up on the whim and start timing the market, unless of course that is your strategy, to buy the dip or whatever your strategy is. Tip number 2, know your exit strategy before you start investing. When you find that new favorite stock or investment, how many of you actually think about the exit strategy when you think about getting in or even buying into it? In my mind, this is actually one of the most important aspects to investing and trading successfully. Depending on your strategy and time horizon, you may not even need to detail out every single step, but at least have a general plan of when you might want to exit. The exit strategy can come in all shapes and sizes. Maybe that's based on technicals, maybe fundamentals, maybe market trends, geopolitical activities, just to name a few, of course. Now the point is, your plan is to stay the course until the business, the technicals, whatever that you're basing it off of is not going according to your plan. Until that turns sour, you should stick to that strategy. Now, when it does go sour, that is when you should exit that position. On to the third tip. So elaborating on the first 2 tips a little more, what are the indicators telling you? Now, these could be technical indicators, it could be fundamentals of the business. Now, whatever it is, understand what that information is telling you. For example, how are the fundamentals of the business or of the market? Now, it all depends on your goal here, of course. If your goal is solely to go by the fundamentals of the stock or the market when investing, it doesn't matter if the stock is volatile or if it goes down 30%, as long as the fundamentals have not changed. This is not financial advice, of course, and I'm not telling you what you should do or what you shouldn't do. But going back to the first point, know your strategy and stick to your strategy unless it goes the opposite direction. Same goes for the technical indicators. If your strategy doesn't tell you to sell or to buy something, and that's contrary to what the other indicators are telling you, well, remember, stick to your strategy and everything else is just noise. This brings us to strategy number 4. Don't invest what you cannot afford to lose or what you can't stand to lose mentally. This is just my opinion, of course, and I would say if you need that money for your next rent or like a big expense that's coming up in the near future, having that invested in stocks or any kind of volatile investment is probably not the best idea. Please set aside some cash for that. Even the most stable stocks or an index fund, it can easily drop several percentage points within a few days or even within a day. If you put your emergency fund in there, that's probably gonna freak you out a little bit here and there. And that's not all. If you can't stand the price fluctuations, especially through volatile times like right now, and potentially losing all the money or a significant amount of money invested, then maybe you should consider investing in somewhat the less volatile assets. And you should ask yourself if the risk versus reward of the investment is acceptable for your investment style. So I think of this as, if the stock pulls back as much as it did in the last major pullback, would I still think this stock or this investment is still a good investment? Or would I think otherwise? Think about what you feel and what you think, in addition to just the technical and the actual price aspect of it. So think of it this way. If you bought Bitcoin near the peak back in, let's say, 2021, with the current drawdown of almost 50%, do you still think it's a good investment, or are you hating yourself for buying Bitcoin near the peak? Now, hindsight 2020, and most of it can't time the market effectively, but if you can't stomach the type of drawdown that you're experiencing, and it's not just Bitcoin, it could be anything really, then maybe you should consider your strategy and the type of investments that you are making, or at least the position size of it. Number 5, are you over leveraged? Before I start, let me tell you, I am definitely not against leverage products at all. And I even use some of them from time to time. In the right context, it can help you multiply your gains when the market is in your favor. You can use a margin account, you can go with options, you can use leverage ETFs, and the possibilities go on and on. There's plenty of options out there. But regardless of which instrument you use, please know your risk before you get your feet into it, and be okay with the risks. So say you're investing in a margin account and you maxed out at 2x leverage, mostly in growth names. Right now, you could easily have been margin called. So are you okay with that risk? And did you know of that risk beforehand? On to our final strategy. Number 6, follow your own strategy and do your own research, not what others tell you to do. Whether you subscribe to a newsletter, you're a big fan of social media, or you have friends who love giving you advice and or maybe just trust them. Well, these people have good intentions and they probably want the best for you. Take full ownership of your own investments and trades. How I see it is, if you can't convince yourself that this is a good investment or trade based on your specific strategy, then you probably shouldn't be making this investment or trade. So the list goes on and on. If you have best practices that you'll want to share, please post it in the comments below. Now, if you found this material helpful, please give this video a like and consider subscribing to this channel for more content like this.